From the outside, scalp trading looks like pure chaos, a blur of blinking numbers and split-second decisions. Surviving that requires the opposite mindset. The physical toll of short-term trading is intense. A typical session might demand 15 to 50 rapid-fire trades. Every single execution forces a decision, and every decision drains a finite well of mental energy. Because these trades occur in such rapid succession, the brain often fails to mentally process the first two losses before a third one arrives. This specific sequence is typically where emotional frustration overrides logic, leading traders to ignore their stops and erase a week's profit in 10 minutes. To stay profitable in this environment, you have to abandon the idea of trading on reflexes and adopt a rigid, mechanical, and entirely emotionless system. The fastest way to lose capital is by staring exclusively at the hyper-fast 1-minute chart. It creates fatal tunnel vision. This excerpt from a professional trading manual outlines the correct approach. Before placing a micro trade, professionals zoom out to the 1-hour, 4-hour, or even daily charts to establish the overall market bias. These higher timeframes act as a map, revealing major supply and demand zones where institutional money sits waiting. Think of these zones as the tide pushing the erratic 1-minute price action, ensuring you never trade against the big players' momentum. Pinpointing that higher timeframe bias is your protective compass. It stops you from being crushed by market forces you wouldn't even notice on a short-term chart. Once you know the macro direction, you drop down to the 1-minute or 5-minute charts to actually hunt for the setup. Here, you are looking for confluence, the alignment of multiple independent technical signals overlapping at the exact same time. You start with your supply zone.
Then check for psychological round numbers, like a clean 50.0 or a major trendline touch. Finally, you check the VWAP, or volume-weighted average price. This metric factors in the amount of volume traded at specific prices, confirming if real institutional momentum is backing the move. By forcing yourself to wait for all these signals to stack up on one single point, you filter out the chaotic market noise. You execute only when the math is heavily in your favor. When the price finally hits that confluence zone, you still don't guess. You wait for a strict price action trigger, like a candlestick engulfing pattern, to confirm the reversal. And the moment you enter that trade, an unbreakable rule takes over. Your protective shield, the stop loss, must be placed instantly. This diagram shows the exact placement protocol. For a long trade, the stop goes strictly below the lowest wick of the swing low. For a short trade, it sits just above the swing high. From there, the exit plan is purely mathematical. You aim for a strict 1-to-2 risk-to-reward ratio. As soon as the trade moves 50% in your favor, you manually slide that stop loss to break even. This rigid combination, a confirmed entry sequence paired with a predefined automated risk parameter, is the only reliable way to strip fear and hesitation out of a live trade. But here is the harsh reality of the math. Even if you stack your confluence perfectly and execute the mechanics flawlessly, that setup will still fail roughly 40% of the time. This chart illustrates a failure scenario. The trader shorts at this red engulfing bar. It looks perfect, but fails as blue candles break upward. The professional response is immediate acceptance. The stop-out triggers emotionlessly, and the trader flips long to capture the breakout momentum. Accepting a disciplined 3-tick loss ensures that a single failed setup doesn't cascade into an account-ending cognitive spiral. A scalper's long-term profitability relies on the stamina to maintain clear decision-making long after the initial